Good afternoon, and thank you for joining this webinar, Spotlight ETFs of the Month. This is a monthly webinar series where we'll be talking about a certain passive products on which, based on current market conditions and future expectations, we are kind of bullish on. And it is also sorts of a way for us to review certain products and talk about nitty-gritties of these products. So, without any further delay, let's start. And before I jump and talk about products, I'll first give a very sorts of a brief update on what is happening in market. And as we all know, the relief rally, which sort of started happening in last 1 month or so, has continued pretty strongly. In last 1 month, now Nifty is up by almost 8%. Mid cap is up by almost 11%, and small cap is up by almost 8.5%. Right, and this is yesterday's ending data. But today also we have seen good performance in the equity market. On Nifty, from its 52-week high, is down only by 4.5% now. Mid cap is only down by 7.8% now, and small cap is only down by 13.6% now. This is a very, very quick recovery, like what we have seen. For example, Nifty at one point in time was down almost 15-16%, and now it is only down 4.5%. Mid cap was roughly down around 20%. It is now only down 7.5%. Small cap was roughly down around 24-25% at one point in time, and post this recovery, it is down only 13.6%. So a very swift recovery. In fact, if we are looking at 3-month data, we can see that mid cap and small cap are up by low double digit numbers, which is again highlights the strength of Indian equity market. Also, if we look from a sectoral point of view, right, it will give us what is driving this rally. I think if we look at let's look at 3 months data, because that will sort of give a more longish view, and you can see that financial services segment is up by 12.8%. And most of these financial services rally was driven by banks itself. So PSU Bank is up by 12.7%, Private Bank is up by 11.6% as well. And then obviously, interestingly, we have seen that the segments which had fallen quite a lot have all sorts of recovered a bit. For example, energy moved up by 14.7% last 3 months, 8.1% in last 1 month itself. Oil and gas index is up by almost 15.6% in last 3 months, almost 10% in last 1 month itself. Capital goods, right? Industrial segments are up by almost 17% in last 3 months, 14.4% in last 1 month itself. And one thing which was lagging, right, if you go down, you'll see that auto, which was not doing so well even in the recovery. So for example, 3-month return, if you look at auto, is only 6%. That also in last 1 month has given a return of almost 13.7%. So auto has also recovered quite well. And more interestingly, I think IT, which in a 3-month period is still looking negative, in last 1 month has moved up almost 15.9%. So very swift recovery in the market, I think, across length and breadth, where we are seeing good moves in large cap, mid cap, small cap, not to the extent of how much mid cap has recovered, but even small cap has shown a good high single digit returns in last 1 month. and also segments like I mentioned, financial services, capital goods have done well. Autos in last 1 month has done well. One segment which has still sorts of not done very well continues to be FMCG, which has given just 1% return in last 1 month and 6.1% return in last 3 month period. I think even the earnings data which are coming out of consumer segment is not very uh, uh, good, right? We are still seeing some sort of downturn, or rather urban consumption not picking up or recovering as what people were sorts of hoping against hope. Also, again, infra in last 3 months is up by 12.7%, and PSU as a general, which had fallen quite a lot in last 3 months, is up by 15.7%. In last 1 month, only 6.4%. So, like I mentioned, a very across sectors recovery we are seeing. If we remove sorts of FMCGs, we are seeing consumption recovery fairly across the board. Now, quickly looking at international market, and and because now we are seeing obviously uh, positive news on trade negotiations and trade deal, right? You already had one deal between US and UK. There has been positive sentiment on now on even on US and China, right? And looks like that a lot of deals are going to happen, and a lot of countries are in negotiation with US, because of which you see that US markets as well as Chinese markets have done well in last 1 month. For example, FANG as of yesterday is up by 18.4%. Nasdaq is up by 13.5%. On a YTD basis, both these indexes have turned uh, positive, right? Nasdaq was almost in bear market territory, so it's a phenomenal recovery which both Nasdaq and FANG has done. S&P 500 also has moved up by 9.1%. On a YTD basis, it is marginally positive now, right? Also on US, I think earnings data has come out really good. If you look, especially IT segment has given very good earnings, and that is also some sorts of supported the good performance of US market. If I'm looking at China now, China Hang Seng Tech, which is a tech centric index, is up by almost 7.3%. Hang Seng is up by 10.8%, which is a broader index. On both these indexes, we have ETF in India. Hang Seng Tech ETF is by Mirae Asset, and then MSCI China is also up by 10.7%. On a YTD basis now, these Chinese indices are up around 18 to 20%. Also, very quickly on the commodities, because a lot of conversation was happening around gold. So, gold, like we mentioned, has consolidated. When gold was touching 3,400, 3,500, we talked about that gold looks like there will be some price correction. Gold will consolidate, and that has happened. And gold is hovering roughly around 3,230 in dollar terms. In international market, in India it's roughly right now around 91,500. So if you're looking at consolidation, that is something which is we are seeing in gold. I think due to all these trade deals happening, especially US China trade deal, will sorts of put downward pressure on gold prices, but the long term strength in gold continues. So I think people should use these dips to add on to gold, but I will not over allocate, right? I will not go uh, over the allocation which I have typically kept in my portfolio for gold. So gold is, I don't think, is going to give very good returns like it has in last 1 year or so. But I think, like I mentioned, it is a good risk mitigator in your overall portfolio. Silver right now is hovering around 32.8. I think if these trade deals fructify, the outlook for silver is more positive than outlook for gold from a performance point of view. Uh, as far as dollar index is concerned, 100.75, 52-week high was 110, so it's down almost roughly around 8 to 9% from its 52-week high. I think Trump administration per se is very comfortable in a weaker dollar, right? And I think that is what we are witnessing. And I expect dollar to sorts of in near term basis hover around these level and possibly weaken a bit further, uh, because I think roughly around 99, 100, $101 index is something which I am looking at, and INR roughly is right now at 85.58. Now these are the passive offerings which we have. Now we have 51 passive funds right across plain vanilla segments, which you can see on the top left. You have Nifty 50, Sensex, Mid Cap, Next 50, Multi Cap, Equity Allocator, which is a fund of fund at a very low cost. It is my favorite fund if you want to do core allocation. It does a very range bound allocation in Nifty 50, mid cap, and next 50. And it is a very good large cap substitute. Direct plan is roughly around 8 9 basis point, including the underlying cost. And direct in regular plan is roughly around 10 to 12 basis point, including the underlying cost. So it is one of the lowest cost asset allocator passive product which is there in the market, and it does the asset allocation, changes the allocation based on views on Nifty 50, Next 50, and mid cap segment. Then we have obviously index funds, which is Nifty 50 large, mid cap 250 index fund, and total market cap index fund. Again, a very good product if you're looking for core allocation. Then we have thematic offerings, manufacturing, EV, and new age automotive. New age consumption, on which we are very bullish on. So one slide which I'll talk about new age consumption, then ESG sector leaders, ETF and fund of fund, and select IPO ETF and fund of fund, which invest in all the new listings, IPOs or spin-offs, and track them for 5 years. A very diversified way to take exposure in new listing. Then we have smart beta offerings, and we'll be talking about alpha, mid and small cap, because we think that post uh, these corrections, these are still available at a very interesting entry point. And I think from a 5 to 7 year point of view, these products can give very superior returns. Then we have sectoral offerings which are typically used for tactical allocations, right? Saw very good interest in financial services, and now we are seeing redemption in financial services since banks and FS have already done really well. And then we have international offerings, about which I won't talk much because they are closed for subscription. All our plain vanilla simple products are lowest cost, one of the lowest cost products in the market. For example, midcap 150 ETF is at 5 basis point, whereas industry average TER is around 17 basis point. Next 50 is at 5 basis point, industry average is around 13 basis point. If you look at bank, around 9 basis point, industry average is 16 basis point. So in plain vanilla products, we are the lowest. And if we are not the lowest, we are one of the lowest from a TER point of view, and that sorts of helps, because typically if you have a lower TER, it reflects in your return, because ultimately the returns which is realized by investors are dependent on returns which index portfolio give, minus the tracking error, tracking and minus the TER. Now we are looking at an overall AUM of 20,000 crores plus on a gross basis in our passive products. So now I'll talk about products which you are focusing on, and the first segment which I'll talk about is smart beta products which we have, and I'll only focus on Alpha 30, small cap momentum quality, and mid and small cap momentum quality, because we feel that right now these segments, and they are still trading at double digit uh, double digit lower level than their 52-week high, and I think there's still a very good entry point in taking exposure in these three strategies. And then I'll talk about new age consumption. From a theme point of view, I think we are right now most bullish on new age consumption, which focuses on investing in companies which are participating in, or which are focusing on discretionary consumption, tapping into discretionary consumption. And then finally I'll talk about multi-cap ETF. I think that's a no-brainer. If you want a simple product which which will provide you exposure across uh, length and breadth of the market in a a decent weight allocation, that's multi-cap, and I'll talk about that also. So I think smart beta, um, um I think most of you would already know. Basically, these are the products which target certain behavior, and their performance and portfolio obviously are based on the behavior which is being targeted. So, for example, momentum and alpha will do well when markets are in bull phases, right? And it will not do well when markets are correcting or markets are sideways, right? Value does well in a broad market recovery, like we are seeing right now. Hopefully, this sustains. Uh, then we have low volatility, which typically does well when markets are volatile. It consists of more defensive set of companies, FMCGs, healthcare, etc. Then you have low size, which means equal weight strategies. Typically, you have Nifty 50 equal weight. It got ours got listed today itself. It's our 51st product, and BSC 200 equal weight, which is an equal weight strategy. Again, it typically does well when you have a sorts of a broad market recovery. Now, in India, now we are looking at an AUM of almost 40,000 crores in smart beta products itself, right? So people are picking smart beta products based on their investment objective and risk profile. So both are very necessary. Everyone wants the product in which they have invested to generate high returns. It is also important to understand how much risk or downside these products can have. So, for example, momentum on alpha product is only good for you if you are willing to take higher risk, if your portfolio can take higher risk, if you can take higher drawdown. So in India also, if you are looking, there are almost 88 schemes right now on smart beta side. Momentum alpha strategies command roughly around 15,000 crores. Then comes equal weight, low vol, multi-factor, value, quality, others, right? So 40,000 crores on this. But then again, I've always mentioned, and this is the most important thing. Unlike uh, broad-based products, factors will have their own cyclicality, right? Like I mentioned, alpha will do well typically in when markets are having a bull run, a sustained bull run, a bit longish bull run. So, if you ask me, if bull run is happening only for next 2 3 months, is it a right time to invest in alpha? Answer is no, right? If you invest in alpha from a 5 year point of view, and there are 3 very good years in these 5 years, should I invest in alpha? Answer is yes. So that's how typically alpha does well. It does well when there is a sustained bull run. Otherwise, it has a higher drawdown during market correction and sideways market. That is what history tells us. Now, on the other side, low vol typically does well in, like I mentioned, in bear market. Uh, equal weight and value does well when markets are recovering, right? So this is the data, right? So I'll just focus on the third column and compare that with first column, which is Nifty 200. So if you look at Alpha 30, does fantastically well in 2024, 2023, whereas it does poorly in a sideways market of 2022. Market gave 4.9% return. It fell by 8.8%. So almost a negative return of uh, underperformance of almost 13-14%. Similarly, just look at 2018. It fell relative underperformance of almost 8%. So what I'm trying to say that there are a lot of greens which I've highlighted. There are a lot of years when alpha does well. More often than not, those will be the years when there's a sustained bull rally, right? 23, 24. If you look at 15, 16, 17, in fact 14 also. So these were the years when there were sustained bull runs, and that is when your alpha will perform really well. But if there's a sideways market or market correction, you will see alpha underperforming also relatively. So 10 to 15% relative underperformance is alpha can give. And if you are okay with that risk downside, then only invest in alpha, and invest in alpha from at least. So see, there are two scenarios. Invest either tactically, you're very bullish that market will do well, you can time the market, or invest at least from a 5 to 7 year point of view, so that you get those 2-3 years of bull run hopefully. And I again contra performances on the low volatility side, which typically does well when markets are, let's say, not doing so well. For example, look at 2018 when markets gave 0.3% return, it only gave 7.4% return. But in the long run, you'll see that these smart beta strategies does well. Alpha, for example, in last 10 years has generated 19% return, whereas 200 has only generated 12.7. So outperformance of almost 6.3% on a CAGR basis. Same outperformance you can see in 7 year, 5 year, 3 year period. Again, this is very important slide which people should, because see what has happened in last couple of years, alpha has done really well, so there's a lot of return chasing also. People have invested, but a lot of people have invested without understanding the downside, right? And this particular graph just illustrates the downside very simply. So Nifty 50 is somewhere here, right? Relatively lower returns, but lower on the risk also compared to a lot of other segments, right? Nifty 50. Small cap is somewhere around here. This is based on 10 years data. Higher return than Nifty 50 and higher risk also. Mid cap, like we know, has in 10 years actually it has done better than small caps. You can see higher returns and higher risk than Nifty 50 but lower than small cap. Just look where alpha and value lies. It has higher return potential but higher risk even than mid and small cap. Same is true in case of value, right? And contrary, as the name suggests, with quality and low vol, your returns will not improve so much, but your risk is actually lower than Nifty 50 also. So this is very significant. So everyone should understand this particular behavior if you are looking to invest in the smart beta products. Again, very quickly, one thing more which happens, especially for low vol, and since I'm not going to pitch low vol for investments this time, but still it is important to understand that some of the factor indices like low vol and quality are bias towards certain sectors, right? Just imagine, think from what are the least volatile segments in the market, and I think the first answers will be FMCG stocks, larger private banks, uh, probably will take a couple of stocks like Reliance, etc., which are not so volatile. They'll take example of healthcare, and that is what you will typically find in a low vol portfolio, right? So they have a tendency to hug these sort of segments and stocks. Quality on the other side will shy away from high leverage segment. So it will have lower exposure to financial services. Will have lower exposure towards capital goods, infrastructure, etc. It will have higher exposure towards IT, FMCG, etc., where typically you'll find lower DE, higher ROE, etc. So, these two smart beta products, you have to be careful from 2 points. One, unki cyclicality, and second is their sectoral biasness. These sort of biasness is not shown by, let's say, an alpha or a momentum strategy, because they will hug on to sectors and stocks whichever are doing well, right? And this is so I'll not talk about this. Yeah, so let me quickly jump on to first product which we are proposing and suggesting, right? And that is alpha 30. Now nifty 200 alpha 30 invest in 30 stocks which have generated highest Jensen's Alpha in last 1 year, which are outperforming in last 1 year, and that is why it does well if there is a sustained bull run, if there's a sustained run in the market, and like I mentioned, that this is a high churn product. The portfolio is assessed on a quarterly basis, and every quarter it is checked which sector, which segment has done well based on Jensen's alpha, and whichever has done well becomes part of the portfolio, right? So just look at the churn in 2020 from a sector point of view. COVID times, the highest allocation was to healthcare because healthcare stocks were doing well. But if you move to 2022, healthcare was not doing well, and in fact financial services were doing well, right? So you can see almost 27% weight to financial services. In 2021, IT was doing well, right? Post COVID, post 2020, when we were talking about work from home, etc. And you can see almost 26% allocation in IT. And look at 23 and 24. If I ask simply, tell me which segments highest allocation would have gone to, you would have easily taken the name of capital goods and financial services, especially on the PSU side. And that was what was forming part of alpha portfolio in 23 and even 24. Right now it is tilted, it has less capital goods, it has more consumer services, financial services, etc. You can see on the rightmost side, and this keeps on changing depending on where the market is shifting. Now, like I mentioned, that this is a high risk high reward product, right? Right now alpha is down almost uh, I think 18% from its 52-week high. So it had corrected, so it was down almost 28% or so, and it has moved up by almost 12-13%. And but still from its 52-week high it is 18% down. But just look at its 2 year, 3 year, 5 year, 7 year, 10 year performance. Even after being down by 18% from its 52-week high, its last 2 year it has generated 32% return versus 20% return by Nifty 200, right? And from a allocation point of view, if you look at segment, in 19 it was large cap tilted, you can see 80%. Then it became much more mid cap heavy, and right now it is even Knievel. It is almost 50-50 large and mid cap. So I think alpha you can look at for potential investment at these levels. What I'll suggest is, and for all these smart beta products I suggest, is that you can do first of all, your investment horizon should at least be 5 to 7 year, and why I'll talk about that in subsequent slides, where I'll talk about how lump sums, staggered investments or SIP investments have done whenever these products have fallen by 20% or so. And so look at staggered investments. Even you can look at lump sum investment at these level, but within horizon of 5 to 7 years. So alpha is there. Then we have a small cap momentum quality, and this is a very unique product. We sorts of conceptualize with NSC. So here 100 small cap stocks are selected based on liquidity metrics. So all these stocks which have high promoter pledging, hitting too many circuits, low volumes are removed, and then stocks are selected based on ROE, low profit variability, low debt equity ratio, means lower leverage, and good 6 month and 12-month risk adjusted returns, right? And if you look so 100 stocks are selected, and we have also capped top stock at 3%, so that there's no sorts of dependency or stock concentration, which can be a bit risky in a pure small cap portfolio, right? You want your small cap portfolio to be liquid enough to take care of both inflows and outflows, right, out of the portfolio. So top stock only has 3% weightage, and last 10 years it has generated 18% return versus 14.8. This year relatively it has underperformed because momentum and quality both has not done well, and I think these quality, especially and momentum, I think this portfolio is primed to do well. Even if you look at rolling returns data, right? Look at on an average basis, it has generated almost 20%, 20.8% rolling returns versus 13.3% or so of Nifty 50. So reasonable outperformance over small cap 250 index also. If you look at rolling returns data from a minimum point of view, from a median point of view, from an average point of view, from a not max obviously small cap 250 has given higher. So again, very good portfolio. I think small cap right now, this product is also down uh, around 18% or so from its 52-week high. So this is also a reasonable entry point if you want to invest in small cap segment. And I think again from a 5-7 year point of view, this product makes a lot of sense. Third product I'm going to talk about is mid and small cap, right? And which is basically 50 mid cap stocks and 50 small cap stocks chosen based on same metrics. So we remove illiquid stocks, we remove stocks where promoter pledging is high. We then look at return on equity, low profit variability, low debt equity ratio. We look at good 6 month and 12-month risk adjusted performance, and then select 50 small cap stocks and 50 mid cap stocks. So and then again, this portfolio does really well. The top stock is capped at 5%. If you look at 15 10-year data or so, you will see how well this has done. And even if you look at rolling returns, you'll see an average rolling return of 20.6% versus 15% of mid and small cap on an average. So has done really well from a rolling return point of view. Also over the period, it has given around 70 to 80% allocation to mid cap and 20 to 30% allocation to small cap. This is India's only product which gives you focused exposure to mid and small cap alone. So you have 50 mid cap, 50 small cap. There's no such product on the active side. There's no such product on the passive side which gives you that mid cap and small cap product. So first talked about alpha. Alpha is something which is only looking at large and mid cap segment. Nifty 200 picks out 30 stocks. Then I talked about small cap, where it is looking at momentum and quality, both picking out 100 small cap stocks. And then I talked about mid and small cap, where it is picking 50 mid cap, 50 small cap stocks based on momentum and quality metrics, like in case of small cap fund. Now very quickly, why am I talking about these funds, right? Because see, post correction, I think we have got a very good entry point to invest in these funds which have corrected, right? So for example, I'm talking about SIP performance, right? If do an SIP in these factor products, for example, across the history, if you look at 3 year SIP performance, you'll see on an average Nifty 50 has given 12.4% return, which will be similar to what large cap funds have also given, add 1% or so. Whereas Alpha has given 17.5% returns for SIP. What we are proposing, mid and small cap has given 21%, and small momentum quality has given 21.8%, like you can see, right? But on the negative side, राइट मिनिमम भी आएगा राइट रोलिंग में एवरेज तो मैंने बोला बट मिनिमम कितना हो सकता है तो देयर हैव बीन पीरियड वेयर 3 year SIP ऑफ निफ्टी 50 हैज गिवन -20% रिटर्न and in case of alpha it can go down to -35 also. Same in case of small cap, like you can see in the data, and mid cap also around 30 plus. But as you move and increase your horizon to 5 year and 7 year, let's talk about 7 year, which I'm mentioning, that if you want to be sure, look at least 5 to 7 year investment horizon. You see that minimum of average of Nifty remains at 12.4%. Minimum is now 1.6%. So negative instances are removed, but your minimum is still 1.6. So marginally positive. But if you look at alpha, the average has moved from 17.5 to 18.9. And your minimum is also now 4.3%. Same in case of mid and small cap, right? Momentum quality. Now your average is 21%. Whereas your minimum is 6.6%. In case of small cap, your average is 21.7% and your minimum is 3.8%. So as you increase your investment horizon in these alpha and momentum quality strategies, you will see your minimum returns being better than even Nifty 50 and your average returns also improving reasonably. So look at least, like I mentioned, 5 to 7 year investment horizon when you are looking into these products. And I think if you are not willing, if you're not able to time the market, which is fine, right? Nobody, I think hardly few people can time the market well. Look at SIP performance, and this is also uh, uh, lump sum investments when these products are down by almost 20% or so, right? People are looking for investment opportunities, right? So I have taken out years when the indices have corrected by 20% or so, right? So it happened in 2011, markets were down 20%. In 2013, only small cap momentum quality was down by 20%. In 2016, again, indices were down by, corrected by 20%. In 18, it happened not with Nifty, but you can see mid cap, small cap were down 20%. It happened in 2020 also. Now, if you do a lump sum investment, right, when markets are down 20%, let me take example of alpha in 2011. It gave a return of 28% in 3 year, 23.8% in 5 year, and 21.7% in 7 year on a CAGR basis. Stupendous, very good performance in from 2011 dips. Same with momentum, mid small cap momentum quality. Gave a return of 23.7%, 21%, 22% respectively in 3, 5, 7 years when markets were down. Investment when markets were down 20% or so. Now again, we look at data at 2016. You look at a good number by alpha, momentum quality, and small cap, and relatively better than investing at that point in time in Nifty's, etc. Right? I mentioned Nifty's number also. Same happened in case of 2018 when a mid small cap momentum quality in 3 year gave 22% return versus mid cap, pure mid cap giving 19% return. Small cap momentum quality giving 24.3% return when small cap gave 20.1% return. I've also done an analysis where what would have happened if you would have started the SIP when markets are down by 20%, right? So instead of doing a lump sum investment, you do an SIP. So a 5-year SIP in Alpha, when Alpha was down by 20% in 2011, would have given 25.8% return, right? A 5-year SIP would have given 16.7% return when it was down by 20% 2016, much higher in both the cases compared with Nifty 50. In 2020, SIP would have given 22.7% return compared to Nifty 50. So, what is happening is that in these cases, when doing a long-term SIP in volatile products makes a lot of sense, right? Because you are able to purchase units, SIP is able to gather units at lower levels in more instances. And that is why you see that SIP performance of volatile products are typically better relatively, right? And just look at performance of mid and small cap also and small cap also, and you can see that SIP has done really well historically in these instances when markets are down, giving you a very, very good uh, entry point. So this was the data on how these products have behaved, how these products have sorts of from a long term point of view, and typically when markets are down, how can we approach investing in these products. Now I have talked about three products on the smart beta side, so you'll ask me which one should I pick, right? So I think my favorite product, to be honest, is mid small cap momentum quality, right? Because here it's a multi factor approach. We are looking at stocks based on both momentum and quality, right? Momentum is high risk, high reward uh, characteristic. Quality provides more sturdiness. I am typically relatively less risk taking investor, so I will probably pick out mid small cap momentum quality. What it also gives me is around 70 30, 80% exposure in mid caps and 20-30% exposure in small caps via 50-50 stocks from mid cap and small cap each. So I think probably if I'm talking about myself, and since I find right now mid and small cap both attractive, I'll probably choose mid small cap momentum quality. If out of all this I have to select one product, someone who is looking for a more risky call, right, who is okay with volatility, I think then Nifty 200 Alpha 30 index is also very good, because this product only looks at top 200 stocks and does well when there is a sustained bull run. So, and as I mentioned, right now it is trading at 18% correction from its 52-week high. And someone who is only looking for small cap allocation, right? He might have a reasonable allocation in large cap and mid cap, but is looking for ideas on the small cap segment side, can look at small cap momentum quality fund, which is again a multi-factor approach to investment in small cap side. So that is how probably I will suggest these three offering, which you can sort of look at depending on your risk profile and depending on your existing portfolio also, right, where you already have an exposure and where you want to add an exposure. Now very quickly I'll talk about two more funds. So all the conversation about smart beta, right? It 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 adds a factor risk also, right? It adds cyclicality. I mentioned that multiple times. But if you are looking at a very core allocation right now, I think we have Nifty 500 multi-cap 50 25 25 ETF. As the name suggests, it takes 50% in exposure in large cap, 25 in mid cap, 25 in small cap. Uh, Invest in all 500 stocks in these weightages, and instead of picking large cap, mid cap, and small cap, you can use this product to take a very sorts of reasonably diversified and balanced exposure in all the three segments. I think this is a no-brainer product. If you don't want to sorts of overthink, and you're looking for core allocation, I think multi-cap strategies is probably one of the best strategies right now for taking exposure in the equity segment in your core allocation. If you don't want to invest in ETF, you can look at our total market cap index fund, which again takes exposure in large, mid, small, and micro also. But there it is more large cap bias, roughly around 68-70% large cap, around 16% mid cap, 10% small cap, and 3-4% micro cap. So if you're looking at ETF, I think multi cap for your core allocation makes a lot of sense. And lastly, if you're looking for a theme right now, I think we are very bullish on consumption theme, and especially on the discretionary side. There is no product on the active side or on the passive side which focuses on discretionary consumption. Discretionary consumption means apart from staples, right? You're looking at automobile companies, you're looking at consumer services companies like e-commerce, etc. You are looking at consumer durables, you're looking at fintech, you're looking at reality also, you're looking at AMCs and wealth management, tours and travels, telecom like Reliance, Bharti, textile, media, etc. Right? Because we have seen the trend that the wallet share of discretionary items is increasing. If people are earning more money, people are spending more on discretionary items, including this does contain portfolio contains of broking companies, wealth management companies, tours and travels, reality, etc. And that is where that incremental money is going in terms of aspirational spending. So if you look at data 3-5 years, this portfolio has done really well. And if you ask me, this is probably we came out with manufacturing a while back, around 3-4 years back. That manufacturing story played out really well, still playing out. And I think for next 5-7 years, we believe that new age consumption story will play out really well. So these were the several products which I wanted to talk about. I talked about three smart beta products, and then multi-cap ETF for core allocation point of view, and new age consumption if somebody is looking for thematic allocation. So that's it from me. If there are any question, please post them in the question box, and I'll be sorts of taking them one by one. So there's one question by Piyush Saxena. He is asking why AI fund and autonomous EV funds are not accepting SIPs. I wish, Piyush, that we were allowed by regulator to accept fresh inflows. As of now, we are not allowed to take incremental money in any of our international offerings because there's an industry-wide limit of $7 billion. So that has been reached by industry. So unless and until you get a redemption, if you get a redemption, a reasonable redemption, you can open that fund to accept incremental money. जितना redemption हुआ उतना ही पैसा. But we haven't got redemption on FANG, Hang Seng, and S&P 500 top 50 much. So those funds are closed, and these funds are also closed because of regulations. Sanjeev Gupta is asking, uh, you should have asset allocator products. So Sanjeev, yes, we are filing for an asset allocator fund for smart beta. If we get an approval from SEBI, uh, we will certainly launch it. But let's see, we are still in the filing process. Uh, Also, we will be sorts of putting uh, a model portfolio on small case, which will do allocation in smart beta strategies. So that is also I think that should happen in next 1 2 month hopefully. And once we do that, we'll also do a session and talk about how you can look at that particular model portfolio or small case, and do which will do the allocation in smart beta products. There's one question by Path. Is it a Path say it is a good time to start SIP Nifty? I think yes. Nifty 5200 Alpha 30. But like I mentioned, have an investment horizon of at least 5 to 7 years in Nifty 200 Alpha 30. Virinder is asking, is trading recommended in these ETFs? How frequently? Yes, Virinder, I think ETFs are used a lot for trading these days. And in terms of taxation, it will be, if you're trading it, it will be taxation taxed like any other uh, equity. So I think a lot of people are doing trading in ETFs, and if it suits your requirement, then you can explore that. Also, there's a question by Sunil Wagh who's asking that many alpha indexes are not part of Mirai. No, as of now, we are not Sunil, thank you for that question. We are not looking to add more alpha product because, see, we believe Nifty 200 Alpha 30 caters to large cap and mid cap. Uh, and I think it's a good segment to be in because Alpha has a lot of churn, right? It has the churn is significant. Even the portfolio churn is more than active funds. So and this segment, top 200, is fairly liquid. I don't have trouble buying or selling these stocks. All these stocks are FNO eligible stocks. If I launch this product in mid cap or 500 space, it becomes very challenging in terms of churning and uh, and managing the fund from a allocation and redemption point of view. So I think and that is why you'll see that typically for those funds, tracking difference is fairly high. Which is not in the case of our fund. Yes, tracking difference is higher because of high TER and high churn, but not because that we are struggling to replicate the portfolio. There is one question by, in Nifty 500 multicap 50 25 25. As you said, investment will be done in all 500 stock. Is it not creating over diversification? Portfolio will be very big, will not be handling. I think, see, Virender, this is a very I think it's a good question because a lot of people sorts of get concerned about the fact that portfolio may have higher number of stocks. Look at the largest small cap fund in India, right? I won't be taking name. I think that small cap active fund has around 250 stocks, right? And it has still done well, right, over the years. So and when it comes to which is the most popular uh, ETF in the world, it is S&P 500. It consists of it consists of 500 stocks, right? So I think just look from a point of view that multi cap 500 stocks are being chosen, yes, but look at it from an allocation point of view. This is a product which will have 50% large cap exposure from a weightage point of view, 25% mid cap exposure, and 25% small cap exposure. I think that blend is something which I like a lot. And yes, there will be diversification, but if you are investing in a passive strategy, you are investing to get returns of the market, right? If you want to obviously play on very focused portfolio that has its own set of risk, additional risk, and I think that sort of product you'll easily find on the active side also. But I think it's a beautiful product. I think yes, there is one question of someone who has invested in Alpha 30 and mid and small cap at lump sum when markets were high. I think yes, you can look at adding in these products. Look at adding. I think I've been talking about adding in last 3 4 months. I hope you would have added when markets were lower. Markets have moved a bit high now, though these products are still not recovered so much. They're still trading, like I mentioned, mid and small cap maybe 10 12% lower, alpha around 17 18% lower, if I'm not wrong. So you can look at adding, but do it in a staggered manner. Look for a bit of the correction and do it in a staggered manner. Which ETF should I go for lump sum investment? I think if your horizon is 5 to 7 years, I'll pick out mid and small cap momentum quality. This one question is why Mira Asset Nifty 500 multi-cap ETF is underperforming. So answer will be no, sir. It is not underperforming. It will give returns how multi-cap segment is giving returns. It's a passive fund, so howsoever those uh, Nifty 500 multi-cap 50 25 25 index will give return minus the expense ratio and tracking error, if any, that will be return which will be given by the fund around that level. So you can check probably, then you'll I think understand what I'm trying to say. Last question which I'll take is alpha products have higher tracking error. Yes, Rahul, and that is obvious, right? Because the churn is so high. Uh, if you look at momentum products and alpha products, the portfolio is completely changed, right, over the year. So that is why it has the churn. In whichever product churn is higher, it will have higher tracking error. See, we should not focus too much on tracking error. You're investing in alpha because of absolute return, right? So expect high tracking error in concentrated portfolios where churn is higher, in alpha product where churn is obviously higher, and typically focus on absolute returns. कि अगर Nifty is giving 12% return with very low churn, and alpha is, let's say, giving 16 17% return with higher tracking error, uh, you still probably go for alpha, right? Because tracking is something which is okay if product is uh, performing better than another comparable product. So there's one question of Pankaj Modi who was asking if I want to invest 100, what kind of percentage I invest in different products like mid, small, and large cap. Pankaj, that is very difficult to tell because I don't know your risk profile, your portfolio, your investment objective, etc. But more often than not, I think I like what a typical multi-cap strategy is, where roughly around 50 60% is large cap, and remaining 40% is mid and small cap. But then again, like I mentioned, that if you have a lower risk appetite, then you should look at a larger allocation, the large cap side. Yeah. So there's one question. So we don't have a defense ETF as of now. So yeah. The last question is there's no brokerage paid to in the ETFs. You can buy and sell them just like stocks on the exchange. For any brokerage or direct or regular plan, or if you don't want to buy an ETF, we have a lot of fund of funds which we have launched, and probably you can look at those fund of funds. So that's it from my side. I hope I was able to clear a lot of doubts around smart beta products, and I hope you would have found the product suggestions helpful. In case you have any more doubts, please get in touch with us through social media channels or through your relationship manager. I'll be happy to guide you further, uh, and resolve any doubts if you have on any of our product offerings. So thank you so much. Have a very good week ahead.